Welcome to Balance of Economy. Before we break down the data, please note that this is market research for educational and informational purposes only, and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. Imagine a company just reported like an 85% jump in revenue.
Yeah, to a record-breaking $81.6 billion.
Okay, not million, billion for a single quarter. I mean, they absolutely demolished earnings estimates, beating expectations by over 6% with an EPS of 1.87.
And they printed a mind-blowing 75% gross margin.
Exactly. They even raised their guidance for the next quarter to $91 billion. So Wall Street looked at those numbers, looked at the GDP of a small country generated in just 3 months, and effectively said, yeah, but what have you done for me lately?
It's wild. The stock price actually dropped 1% post-market.
Welcome to the deep dive. I mean, it sounds like a glitch in the matrix, right?
It really does. You print perfect financials and your valuation shrinks. But when you look at the underlying mechanics of where the tech sector is right now in 2026, it actually makes a brutal kind of mathematical sense.
Today, we're unpacking this exact scenario, what analysts are calling the NVIDIA paradox. We're going to figure out why perfect earnings just aren't enough anymore.
Because if you hold any major index funds right now, you're essentially betting a massive chunk of your portfolio on NVIDIA achieving, well, mathematical perfection for the next 5 years.
Right, so you really need to understand this dynamic. We're also breaking down the very real, very well-funded hardware rebellion led by Google and AMD. And we'll get into the whole Intuit software fracture, too.
Oh, yeah, the software fracture is a huge piece of this puzzle.
Definitely. And then we're going to reveal the exact mathematical criteria institutions are using to find hidden, undervalued tech gems in a market that is fundamentally fracturing in two.
The overarching theme here is a sudden, aggressive shift. The capital isn't drying up, but it is, moving into unexpected layers of the AI supply chain, leaving the momentum chasers highly exposed.
We are synthesizing a massive stack of financial intelligence today for you to map this out. We're pulling from MorningstarInvesting.com, The Motley Fool, Forex Quebec, L'Espresso, and technical breakdowns from Pasquale Piliteri.
With a lot of data.
It is. So let's stay on this Q1 fiscal year 2027 report for NVIDIA. $81.6 billion in revenue, a 75% profit margin. I have to push back on Wall Street's reaction here. How does a company beat every possible metric and still get punished by the market?
What?
I mean, is the actual business growth slowing down, or is the market just throwing a tantrum?
No, the growth is absolutely not slowing down. What you're seeing is a phenomenon known as the perfection trap.
Right.
You really have to look at the sheer weight of the valuation.
Right, it's massive.
Exactly. NVIDIA's market cap has crossed $5.3 trillion. They're trading at a PE ratio of around 45 times their trailing earnings. When a stock is priced in that stratosphere, the market has already baked in years of flawless, uninterrupted, exponential growth.
It reminds me of like an Olympic gymnast who has scored a perfect 10 on her last 50 routines.
That's a great way to look at it.
Right. The crowd just assumes she's going to hit every single landing. If she goes out there and scores a 9.9, she still wins the gold medal by a mile, objectively outperforming everyone else on the planet. But the crowd gasps and assumes her career is over.
Because the expectation wasn't excellence. The expectation was flawlessness. That captures the market psychology perfectly, really.
Yeah.
Wall Street doesn't just demand that NVIDIA beats the consensus anymore.
They need more.
Right, they demand earth-shattering surprises just to justify moving the needle further up. If they merely execute brilliantly, it's seen as a disappointment because perfection is the baseline.
But if perfection is already priced in, where is the upside? The bull case can't just be, oh, they'll figure it out. There has to be a catalyst that Wall Street isn't fully pricing in yet.
Well, Bank of America's top semiconductor analyst, Vivek Arya, actually laid out that exact bull case.
Yeah.
He raised his price target to $320, which implies a 42% upside from the post-earnings slump.
Wow, 42%.
Yeah. And a justification comes down to two massive capital flows that are still accelerating. First, you have the hyperscalers. Amazon, Microsoft, Alphabet, and Meta are collectively dropping $725 billion in CapEx in 2026.
$725 billion. That is a staggering amount of concentrated capital.
It is. And a massive chunk of that is dedicated entirely to AI infrastructure. They're physically incapable of building data centers fast enough to house these chips.
But you mentioned two flows. What's the second?
Sovereign AI. This is a completely new segment of demand that, it didn't even exist 3 years ago. Yeah, entire governments are now treating compute power like strategic national reserves. They're building their own native AI infrastructure for national security, local language model training, and data sovereignty.
Because they don't want their classified data processed on American servers,
Yeah.
obviously.
That sovereign segment alone brought in $30 billion for NVIDIA in fiscal year 26.
That is a fascinating geopolitical shift. Entire nations are acting as individual enterprise customers. And speaking of geopolitics, the sources highlight a massive wildcard here.
The Beijing trip.
Yeah. NVIDIA CEO Jensen Huang recently traveled to Beijing alongside Donald Trump. We're looking at this strictly from a market perspective, but the financial implications of that meeting are massive.
Huge.
The U.S. export limits essentially severed NVIDIA from a $50 billion Chinese AI market. They were barred from selling their top-tier H200 chips there.
Right. And Huang's presence in Beijing with leadership signals a potential diplomatic unfreezing. If there is any resumption of H200 chip sales to the Chinese market, that unlocks $50 billion in pent-up demand overnight.
So that would be the surprise.
Exactly. That is the kind of unexpected, massive catalyst that NVIDIA needs to break out of the perfection trap and force the market to reprice the stock upward.
But here's the problem with a total addressable market projected to hit $1.7 trillion by 2030. You cannot guard a pie that big forever.
No, you really can't.
NVIDIA's profit margins are a giant target painted on their back, which leads us to the fact that their hardware hegemony is finally facing credible existential threats.
Yeah, the landscape fundamentally changed at Google's Cloud Next 2026. NVIDIA hasn't faced a legitimate threat to its data center dominance in years, but Google dropped a bombshell with their new custom silicon.
The tensor processing units.
Right, specifically the TPU-8T and the TPU-8i.
I dug into the specs on these, and Google is taking a highly specialized approach. The TPU-8T is designed specifically for training models, boasting 3 times the power of its predecessor with 9,600 accelerators in a single pod.
Which is massive for training.
But the 8i is what really changes the game. It's designed explicitly for agentic AI.
You hit on the crucial distinction there. Training a model requires brute force computation. It takes months of churning through data. But inference...
Which is the 8i's focus.
Yeah, inference is where the margins are won or lost in the real world. Inference is the model actually answering a user's prompt. Now, take that a step further to agentic AI.
Okay, what does that look like in practice?
These are systems that don't just wait for you to ask a question. They actively run in the background, executing multi-step workflows, communicating with other software, and, making decisions.
So it requires a completely different chip architecture. You aren't just doing heavy lifting once, you're doing millions of tiny concurrent micro tasks constantly.
Precisely. Google designed the 8i with 1,152 chips per pod, specifically to serve millions of these autonomous AI agents simultaneously. High concurrency inference is a totally different sport than brute force training.
And Google isn't just building these for their own search engines, right?
No, the real bombshell in our sources is Google's $40 billion investment and a 5-gigawatt compute deal with Anthropic.
Let's pause on that number. 5 gigawatts. To put that in perspective, 1 gigawatt can power roughly 750,000 homes.
It's unbelievable.
Google is dedicating the equivalent power consumption of a major metropolitan city entirely to Anthropic's AI computation on their TPU infrastructure. Jensen Huang even publicly admitted that failing to invest in Anthropic early on was a massive strategic mistake for NVIDIA.
Right, because Anthropic committing to Google's TPU infrastructure proves that the most advanced AI labs are willing to look past NVIDIA if the custom silicon is tailored to their exact workload.
So Google is attacking from the cloud side.
Yeah, and meanwhile, AMD is mounting a massive assault on the raw hardware front with their MI400 chip.
AMD is playing a very specific game here. They are trying to win the memory war. The MI400 features 432 gigabytes of HBM4 memory, completely dwarfing NVIDIA's B200, which only has 192 gigabytes.
So more than double the memory.
But here is where I get stuck. If AI is entirely bottlenecked by memory bandwidth, getting the data into the processor fast enough, and AMD gives you more than double the memory, and Google's TPUs are cheaper to run in the cloud.
Why hasn't NVIDIA's 75% profit margin collapsed already?
Exactly. Why doesn't every data center just rip out NVIDIA and switch today?
Well, you're forgetting NVIDIA's deepest defense strategy. Their moat isn't just the silicon. It's the software in the networking ecosystem.
CUDA, right?
Yes. They have a software platform called CUA that AI developers have been locked into for nearly 2 decades. Switching your data center to AMD means rewriting massive, complex code bases. It is a logistical nightmare.
So it's the ultimate ecosystem lock-in.
It is, and NVIDIA knows the custom silicon threat is real, which is why they just invested $2 billion into Marvell, a company that specializes in networking.
Okay, so they're expanding the moat.
Exactly. NVIDIA is opening up their proprietary NVLink ecosystem to work with Marvell's tech. They're ensuring that even if a hyperscaler decides to use their own custom chips for certain tasks, NVIDIA's networking infrastructure remains the indispensable central nervous system.
Just moving the data between those custom chips.
Right. They're embedding themselves so deeply into the physical architecture of the data center that you simply cannot build one without them, regardless of whose logo is on the GPU.
If AI is a high-speed bullet train, everyone is fighting over who builds the engine. But nobody is looking at the tracks.
That's a great analogy.
And while we're talking about NVIDIA's incredible hardware success, we have to contrast this with the brutal reality happening on the software side. The tech sector is splitting.
Oh, the software fracture.
Yeah, look at the Intuit case. While hardware is booming, Intuit just went through 17% layoffs, and their stock dropped significantly.
It's a perfect example. The hardware layer is doing incredibly well, but the software layer is facing a completely different reality.
Right. If the hardware layer is becoming this brutal, capital-intensive war between NVIDIA, Google, and AMD, where is the smart money actually looking? According to a breakdown from La Table des Investisseurs, AI is an entire, deeply complex supply chain, not just algorithms and graphics cards.
Exactly. When retail investors stare blindly at the tip of the spear, the GPUs, they completely miss the massive physical infrastructure required to support it.
The hidden layers.
Right. There are companies operating quietly behind the scenes that are absolutely vital to the AI revolution, and they're immune to the hardware wars because whoever wins the GPU battle still has to buy their components.
I love this angle. If we go back to the bullet train analogy, we need to look at the tracks, the signal lights, and the ticketing systems. Let's map out these hidden layers.
First is the infrastructure layer. Companies like Arista Networks and Lumentum, they handle optical networking.
Which is crucial now.
Yeah, because when you're pushing terabits of data per second between thousands of GPUs, traditional copper cabling literally acts like a toaster element.
Wait, it just melts.
It heats up, it melts, and it bottlenecks the entire system. You have to transmit data using light. So these optical networking companies are quietly making a fortune replacing copper with lasers and glass in every major data center.
And all that data has to sit somewhere, which brings in the data storage layer, Western Digital and Seagate. Large language models require gargantuan training sets, and the agents we talked about earlier generate their own massive logs of data.
Then you have the cybersecurity layer, Palo Alto Networks and Fortinet. As enterprise companies digitize their operations and integrate AI, their attack surface expands exponentially.
Because AI can generate cyber threats faster than a human security team can even read the alert.
Exactly. You need automated AI-driven security responses to fight fire with fire.
We also have the software layer. The sources mention Synopsys, which is fascinating because they actually design the highly complex software used by engineers to map out the physical architecture of the microchips themselves.
Right, the tools to build the tools.
And ServiceNow, automating workflows inside massive enterprises. But I have to push back here. Just because Arista or Synopsys are in the right sector doesn't mean they are good investments right now. How do we know these infrastructure companies aren't also caught in their own perfection traps?
You avoid the perfection trap through ruthless mathematical screening. Investing.com detailed a specific institutional-grade screener designed to find undervalued tech in a market that is aggressively splitting into two camps.
Stripping away the narrative.
Exactly. It looks only at the fundamentals.
I'm looking at this screener, and the criteria are brutal. First, a market cap over $3 billion, so no highly speculative microcaps.
Right.
Second, the stock must be trading at a greater than 20% discount to its fair value. Third, it requires greater than 50% upside based on current analyst price targets. And fourth, a financial health score above 2.5 out of 5, meaning the company has strong cash flow and low debt.
This very tight filter.
It seems mathematically impossible for a high-growth AI-adjacent stock to clear that hurdle right now. Who actually survives that screen?
One of the standout survivors is Pega Systems, ticker Pega. They operate in enterprise automation, effectively using AI to streamline massive corporate workflows.
Okay, so why did they make the cut?
The reason they survived the screen is their margin profile combined with a temporary market mispricing. They boast 75% gross margins, matching NVIDIA's profitability, by the way.
Wow, matching NVIDIA.
Yeah, and they're experiencing massive cloud growth. However, due to a brief localized stock correction in Q1, they are currently trading at an incredibly low 11.7 times forward earnings.
11.7 times forward earnings for a company with 75% margins in the AI automation space. That is the exact opposite of the perfection trap.
It really is. It's a fundamental disconnect between the underlying business health and the stock price. Another company surviving the screen is Futu Holdings.
Oh, the brokerage platform.
Right, an Asian brokerage platform expanding rapidly into the U.S., operating with 88% gross margins. It's a highly profitable cash engine that broader market is currently mispriced because they aren't, a household AI name.
Morningstar also provided their own list of heavily discounted tech stocks that plummeted during the Q1 tech drop. Let's look at the mechanics of why these companies are fundamentally insulated.
Well, Morningstar highlighted Atlassian, which is currently trading at just 0.31 of its price-to-fair value ratio. That means it is trading at roughly a 70% discount to what Morningstar calculates the business is actually worth.
How does a company like Atlassian secure its moat? They make productivity software like Jira and Confluence, right?
Their moat is their viral, low marketing spend loop. Most software companies burn massive amounts of cash on enterprise sales teams. Atlassian relies on a land and expand model.
How does that work?
One engineering team starts using Jira, they invite another department, and it spreads organically throughout the entire company. This mathematically shields their gross margins during a sector downturn because they aren't heavily reliant on advertising spend to acquire users.
That makes total sense. Morningstar also flagged Klarna, trading at a 0.29 price-to-fair value ratio as they aggressively expand in the U.S. and pursue banking licenses.
And Zscaler at 0.47 price-to-fair value.
Right. Zscaler is pioneering zero-trust cloud security. Instead of routing all corporate traffic through a slow, centralized security bottleneck, they route users directly to cloud applications safely.
What you're seeing across all these companies, Pegasystems, Atlassian, Zscaler, is the value protector strategy in action.
The value protector.
Yeah, the market is so obsessed with the trillion-dollar hyperscalers that it's leaving deeply profitable, high-margin infrastructure and software companies trading at massive discounts.
So if you are an investor, you're watching a real-time fracture in the market. You are either a momentum chaser riding the massive waves of NVIDIA and the hyperscalers, accepting that you are paying a heavy premium for perfection, or you are a value protector, hunting for fundamental mathematical discounts in the software and infrastructure layers that the momentum chasers are entirely ignoring.
The AI revolution isn't a monolith. It's a sprawling, multi-layered ecosystem. And the capital value is constantly, quietly shifting between the different layers of that ecosystem while the headlines focus on the shiny objects.
Let's summarize the mission we set out on today. We unpacked the NVIDIA paradox, breaking down why $81 billion in revenue and 75% margins can still result in a stock drop when Wall Street has already priced in absolute flawless execution.
Right.
We analyzed the legitimate multi-billion-dollar hardware threats from Google's agentic TPU 8i architecture and AMD's massive memory advantage with the MI400.
We compared those incredible hardware margins to the software fracture we saw with Intuit.
Exactly. And finally, we walked through the exact mathematical metrics required to screen for the hidden, undervalued layers of the tech revolution, identifying companies like Pegasystems and Atlassian that boast massive margins but trade at steep discounts.
As we look past the current hardware wars, I want to leave you with a final lingering mechanism to think about. We've talked extensively about the massive data centers, the gigawatts of power, and the giant chips required to run AI today.
The brute force approach.
Right. But the underlying trend of technology is always miniaturization and efficiency. As these chips become relentlessly more optimized, especially with inference architectures like Google's TPU 8i, the AI models themselves are getting smaller and smarter.
They require less compute to achieve the same result.
Exactly. What happens when the models become so lightweight and the hardware so efficient that enterprise AI can run entirely locally on our phones, laptops, and edge servers?
Oh, wow.
Could the ultimate long-term winners of the AI revolution actually be the end-user companies? Imagine their profit margins skyrocketing in a few years because they no longer have to pay the massive centralized hardware toll to NVIDIA or the cloud computing fees to Google.
The ultimate disruption to the hyperscalers might just be the decentralization of AI itself.
It's a very real possibility.
That is a brilliant final thought. The companies that win the AI war might not be the ones building the hardware, but the ones who figure out how to bypass the hardware toll entirely. In a market this split, you are either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed.